Okay, so hello everyone. Good morning to the macro snapshot. It is Thursday, June the 13th, 2024. We'll just do a quick one this morning because we have the PPI and whatnot. But first of all, guys, let's have a quick look and see what happened with the Fed. I think everyone probably knows at this point. The main takeaways were, of course, that they see the Fed funds rate at 5.1, so that instead of having 3 cuts, which had been the projection back in March, you can see here it went from 4.6 up to 5.1. So now only 1 cut priced in for 2024. So that's definitely hawkish, but also why was that hawkish? The market was probably pricing in more like just 1 cut to be withdrawn, but the Fed has basically said, what they're projecting now is 2 cuts to be withdrawn. So that was a bit more hawkish. On the other hand, of course, in 2025, they actually added there's now meant to be 4 cuts between 2024 and 2025. So rather than 3 cuts in 25, they're now saying they're going to be 4 cuts. Now, what was probably most interesting as well is 2.8% for the longer run is the new figure, so revising upwards. So that's basically saying that maybe they're not as restrictive as they think, because if they think that the neutral rate is, sort of 80 basis points, so the 0.8 here above the 2% inflation target. That's saying that maybe over the medium to long run, they do think that the neutral rate, the equilibrium rate, needs to be revised a little bit higher. So my takeaway from that is that the Fed is acknowledging what the economy is telling it. And that also means that maybe the terminal rate, there's going to be a shallower than sort of normal or historically normal cutting cycle. And also maybe that the long end yields will not come down terribly much over the next sort of year or two, unless we have some kind of sort of disaster. The other thing which I took away from the Fed and the press conference from Powell was the idea really that we're going to be that the data dependent. I mean, if Powell at this point, because the protocol is obliged to, or the Fed is obliged to do the dot plot here, but at the end of the day, all of this represents is really what the market, what the committee members believe is the situation of the economy as of today. What's their reaction function of today? But as everyone keeps on telling us, the committee members in Powell, they are super data dependent. They don't really know. They're going to react to the data rather than sort of actively forging a forward path. So the point is that these dots here are at, they what they were thinking probably yesterday, rather than, really where the dots and the Fed funds rate will be over the next sort of 12 or 18 months. So that brings us back to a very simple situation that the market, let's have a look, went up and down. It went down on the PCI, the CPI. So obviously yesterday we got a lower than expected CPI, and initially the bonds rallied, the front end rallied. So we had a front end led sort of a bull steepener. The stocks loved it. Gold had an initial rally, and the US dollars sold off. So we had a classic sort of dovish reaction to that. But that wasn't, essentially sort of reinforced by the Fed's messaging and Powell's messaging. He said, whoa, let's all just calm down. We're going to be data dependent. We need to see, probably essentially, he didn't want to be committed, but essentially another 2 or 3 probably consecutive sort of soft readings in inflation, and then they might think about cutting. So at this point, let's see what the market is pricing in after all of that. Let's just go up here to the monitor. So what we can see here is if we actually, sorry, I need to just actually put that in. Sorry, guys. Give me a second. Where is it? Well, so as we can see, as of now this morning, we can see that the market before the Fed meeting had been pricing in. It got it higher as 50 basis points of cuts, so 2 cuts, and then as low as 35 basis points. Now, essentially, what's happened is that the market is taken back a little bit, and we can see a reaction here. Let's just have a look and see how that. Let's say, for example, the December pricing reacted yesterday. If we put that on, I don't know, a 1-minute chart, or maybe a 3-minute chart over the last 3 days, that'll give us a bit of a sense of what's going on. And you can see here, this is at 8:30 yesterday morning with the CPI. You can see that the market at that point had been pricing in 40 basis points, or about, what's that, about almost 1.5 cuts. And then on the CPI, it ripped downwards towards 51 basis points. So 2 full cuts were being priced in. And then, the market fiddled around. But as Powell started, with the dot plots coming out and then Powell's press conference, as you guys can see, the market sort of hawkishly repriced a little bit. and didn't go all the way back to pre-CPI, but went back about 2/3. So now we're settling in at 44 basis points, which, if we want to put that in decimal terms, is about 1.75. So 1 3/4 cuts. So between 1 to 2 cuts being priced by the end of the year. So the market is still pricing in cuts. And I think what's going to happen is that over the summer, the next couple of months, we're probably going to have relatively frustrating sort of mean reversion range trading, because I think any sort of real economic data, any commentary by the Fed is going to be, any failed auctions, all of this stuff is going to be taken as sort of hawkish. The yields will go up, the bond prices will go down, stocks might take a very temporary kind of hit, gold will come down, the US dollar will rally, but then it's probably going to mean revert, depending on the data. So I think the way we need to be setting up for all of this is to be just establishing levels. I don't my point is, I don't think there's going to be any sort of very strong trending moves, especially in the bond space, over the next couple of months. We will not really get that until and unless we get absolutely stellar, super hot economic data, or until and unless the Fed actively starts cutting and actively starts to say, okay, we have started to descend the mountain and embark on a cutting cycle. But we're not there yet. Are we going to get there? Some people saying sort of maybe September, other people saying it's too close to the election, other people saying they'll wait completely until the US election and go in December. We shall see. I think really the Fed wants to cut, but they need a little bit more confirmatory data. And keep in mind that the Bank of Canada cut along with the ECB in the last couple of weeks. We have the BOE coming up in the summertime as well. So it could get to an interesting situation where some of the world's larger developed market central banks have cut, but the Fed is staying on the sideline. Okay, so let's just have a quick look and see the reaction here. What we're seeing this is the stocks, this September contract. Keep in mind we rolled over yesterday, so that it looks on the continuous contract like there's a bit of a jump upwards, but that's just basically the roll in the contracts. What we can see here, pretty simply, this is a very bullish chart. I'll keep it very simple. This is an extremely bullish chart. If you want to measure out, hold on, let me just get some tools here. If you want to measure out some kind of Fibonacci extension, I mean, we're breaking into new highs. So you have, one sort of fib extension all the way up to about 57, 58, 5900. If you want to go on a shorter term measured move, which would be, let's say, something like this, you can see that one measures out. It's still a little bit higher, 5,600, 5,700. And maybe even just to have a bit of fun, we could put in, I don't know, maybe even a sort of a medium term measured move. And that measures, well, that's getting towards the end of it, that one there. But I would say in general, it would not surprise anyone if basically the stocks kept on pushing higher. Now we know that it's relatively sort of narrow. The cone, as they say, is relatively narrow, and most of the big tech stocks are the ones leading this, the Nvidias and whatnot, the so-called Magnificent 5 or 6. But we also saw yesterday Broadcom doing super well. Apple breaking out of its sort of, if you look at Apple breaking out, as we all know, out of its sort of year-long range. I'll just quickly throw that in. And so the point is here, Apple giving up a little bit, but again, if you want to sort of see where this could extend to, this could extend a little bit further. My point is that the stocks have a bit more to go. And in the absence of, I mean, we have now a market or a real economy which is doing quite well, although possibly slowly slowing down. But the reality is that the real economy is doing quite well. We have a Fed which is clearly wanting to cut and is just waiting for the signal to do so. And we have inflation data, which is, even if it's not completely down at target, is gently drifting down towards target, we can assume, over the next 6 to 9 months. So those are the conditions which are relatively benign for the stock market. And the other thing as well is that if we're going to have a shallower cutting cycle, if we're going to have a neutral rate, which is going to be higher than it has been historically over the last 10 years, we still have a lot of issuance. You have to say that, all things considered, one would probably prefer stocks over the long end of the curve, and maybe over the front end of the curve until and unless we get the Fed. So I think any dips in the stocks should be bought. It's pretty much simple as that. And what we're seeing in the sectors as well is that big tech still seems to be the favored one. So I think the trade is just to look at sort of ranges on things like the NASDAQ, on the Qs, on the SPY. Any sort of reasonable dips should be bought. Probably, even specifically in the big tech. I mean, why not? Or the semiconductors, that they seem to be the ones which are outperforming. Keeping in mind in terms of the bonds, I'll just show a quick look here at the yields. And what we saw yesterday, so we saw that initially, you see the 2-year yield here, it spiked down a little bit just on those the weaker CPI, but basically, again, like everything subsequent to Powell and during Powell, I gave it back a little bit. Again, I think over the summer, this is going to be range bound, probably, going to be capped around about, 500, 508 basis points, and on the downside, more or less where we are here, 470, something like that. Yesterday, this similar kind of price action here on the 30-year bond, coming down on the CPI, going back up. Again, I think it's going to be relatively range bound. We do have the 30-year auction today at 1 p.m. That's going to be interesting. If the market doesn't take that down or absorb that easily, that could put some upward pressure here on the long end of the curve. We could start seeing a little bit of bear steepening there, which is not going to be great for gold. But the stock market at this point has shown that it is relatively resilient to these slightly higher yields. Indeed, it has absorbed them. And so what I priced them in. So what I would say is that the stock market will probably only really start to feel any degree of pain with the long end yields if the long end yields, really go up another, sort of 25, 30, 40 basis points, something up sort of here, which is basically the highs we're getting in the yields at the end of April. So keep your eyes though on the 30-year yield. On the other hand, if the bond auction today does go well at 1 p.m., that could be another sort of tailwind for the equity market to push a little bit higher. The other thing just to be keeping an eye on, guys, is the yield curve here. I've got the 2s, 30s. To be honest, not a huge amount happening. Again, we're kind of in a range, and I think what's going to happen is that we will probably range trade over the summer between this negative 35 up to, what I've marked here about, minus 13, something like that. And that's just simply going to be based on, Fed commentary, the possibility, anything which tends to be leading us into the direction that, the Fed might start their cutting cycle sooner rather than later. That will probably steepen the curve bullishly. Anything which is showing that the economy is very, very resilient might sort of steepen the curve from the long end. Or difficult to say. It depends. Maybe probably would have to be an inflation number. So I think that the bias is a steepening. I mean, it's probably not a bad bet if ever this curve gets down to like 35, 36 negative basis points here. It's probably not a bad entry point, anyone considering putting on a steepener play, because I think overall a bull steepening eventually, and possibly even a shorter term bear steepening, is something which is in the cards. So that's something interesting there. Okay, looking at gold. Gold initially popped a little bit on the CPI, but again, like everything subsequent to Powell, we're seeing gold giving back a little bit. And I've got to say here that unless we get an extremely dovish PPI, and maybe let's say a higher than expected initial jobless claims, which we have this morning, I think the gold could push down a little bit more. On the other hand, if we do get some dovish data this morning, maybe gold will just sort of fiddle around in this range here. Talking about that, and the same thing for the US dollar, by the way. I won't dwell too much on it because we're running out of a bit of time here. But the US dollar, again, was reacting yesterday to the two main events. So we saw the US dollar, initially sort of weakening pretty strongly on the lower than expected CPI. But again, like everything else, just clawing its way back about 50%. So I think, again, that's going to be very data dependent. Just to finish up here, guys, let's look at the data for this morning. As always, on a Thursday, we do have the initial jobless claims. Remember last week that came in a little higher than expected. So that's showing a labor market, which in theory is slowing down a little bit. But again, remember that the day after last week, we had the non-farm payrolls, which was strong, although the unemployment rate went up. So there's a lot of confusion, or I don't want to say confusion. The point really is that with all these, let's say, for example, the labor market, you need to be looking at 5 or 6 different indicators and trying to agglomerate them a little bit to get some sort of sense of what's going on here. But anyway, the initial jobless claims, as you see last week, 229,000. Expected relatively high, 225 this week. We shall see. But I think really the important one is going to be the PPI, the producer, like the gate price for producers. Some people saying that energy prices have been relatively low over the last sort of month. So therefore, maybe these are going to be expected to go a bit lower, the producer prices. The other thing as well, keep in mind that a lot of the elements which go into the producer prices are used with the same methodology and metrics to go into the core PCE, which of course is the Fed's preferred inflation metrics. So the idea here is that once economists see the PPI, they can extrapolate out to a certain degree the upcoming core PCE, which I think is at the end of this month, maybe the 28th or the 29th of June. And so that could be relatively important today, the PPI. Why? Because if these numbers, which are expected to come in on the low side, you see here previous minus, 0.5, headline month over month 0.1, and the ex-food and energy, which of course is the most important one, of month over month is expected to fall from 0.5 to 0.3. So the point is that if these come in as expected as a decrease compared to last month, that could support the narrative we got yesterday that inflation pressures are moderating. And that could, give a little bit of a tailwind to, let's say, sort of risk assets or risk currencies like the Australian dollar, let's say the stock market, probably the front end of the curve, and probably gold and precious metals. On the other hand, the market did see sort of a pretty soft CPI yesterday, and the expectations are fairly low here for the number for PPI. If these numbers do not match expectations and come in, higher than expected, that could, cause a little bit of a sort of a nasty short-term sell-off in the front end of the curve, in, let's say, the precious metals. Something like the risk, like the Australian dollar, New Zealand dollar, Canadian dollar, the Norwegian krone. US dollar should benefit. And the stocks might have a temporary sort of setback here. Probably not as much as the stocks, but it could be like a temporary setback. Anyway, so interesting. And of course, look at those numbers from PPI in combination with the initial jobless claims. Okay, I'll leave it there, guys. Have a great day, and we shall be talking soon, no doubt. Thank you.